Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at three tech giants to consider buying and possibly holding for a really long time. And those three stocks are Adobe, Intuit, and Meta Platforms. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more. All right, so before we jump into these three stocks, I want to do a broader market overview to give a sense of why we might be looking at these three stocks and big tech in particular. So March and obviously 2023 as a whole has been pretty volatile as market participants, big and small, are attempting to assess the rapidly changing outlook for rates in the economy. So we saw the NASDAQ bounce back since that Monday scare and last Friday's scare with the hopes that now the financial sector will be maybe not in such a bad place after the Silicon Valley Bank and Signature Bank failures. So the Fed and U.S. officials took pretty quick and rather extraordinary measures to nip any potential wide-scale banking crisis in the bud by essentially guaranteeing all the deposits to prevent a panic and further runs on the bank. So we even saw First Republic Bank stock pop Thursday, though it was back down again last time we looked on Friday. So the banking sector, maybe not a play at the moment, which is once again why we're looking at the broader tech sector as well. Meanwhile, the tech giants are continuing to climb as investors feel more confident in a Fed pivot. So eventually lowering interest rates at some point in 2023, which we'll get to in a second, and the ability for these firms to grow for years, if not decades to come, kind of no matter what the economic environment is. So we saw the NASDAQ surge 2.5% on Thursday, with it at the time on Thursday up roughly 13% so far in 2023. So the last time I looked on Friday, we did see some selling. So this is through morning trading on Friday. The NASDAQ was down about 1% the last time I looked, with the S&P 500 down about 1.25%, which makes sense after that nice bounce back yesterday. So despite that decline on Friday for the NASDAQ through the morning, it is still back above both its 50-day and 200-day moving average. So that's a really bullish sign. And we should note that the index experienced a so-called golden cross recently, which is a bullish technical signal when the 50-day crosses back above its 200-day. And meanwhile, the S&P 500 is back above its 200-day as well after that pop on Thursday. So moving on to the Fed, Wall Street has swung rather significantly in recent days regarding where it thinks it's going to be in terms of that hike next week. So on Wednesday, traders were essentially split down the middle between whether there was going to be a 25 basis point hike next week or no hike at all. Now that same system, which is the Fed watch tool from the CME, places about a 70% chance on a 25 basis point hike and a 30% chance that it's going to remain unchanged. And this is as of Friday, the last time I looked. So the renewed confidence in a 25 basis point hike came after the European Central Bank announced a 50 basis point hike on Thursday. Still, though, traders are now essentially starting to bet that the Fed's going to pivot by the summer. And if we fast forward to March 2024, the market's saying there's over a 90% chance that we'll have lower rates than they are at the moment. And then in terms of 2-year U.S. Treasury, so the short-term Treasury rates, they were back down to 3.9% the last time I looked, after hitting about 4.16% yesterday. So there's just been huge fluctuation in these Treasuries. There's been some liquidity crunches as everyone rushed to safety. And this is, though, down way below those 5% highs from last week. So they've swung wildly from 5% to 3.9% as investors price in a pivot and rush to safety amid all of those banking scares. I also wanted to point out, though, that even though the market feels really volatile at the moment, the VIX, so that CBOE volatility index, remains well below where it was back in October of 2022, so not that long ago, and way below where it was at the initial COVID sell-off, and it was way below where it was a bunch of times in 2022. So despite it feeling really volatile at the moment, those options pricing, which is how that VIX gets calculated, are not as crazy as you might think amid all of the chaos in the last week. So with this in mind, we're going to take a look at those three big tech stocks at the moment to consider buying for the long haul. even though you might want to wait as we get into maybe for some better, more precise entry points. But as I said, if you're a really long-term investor, trying to time things exactly can end up eventually causing more harm than good. So the first stock we're to look at today is Adobe, which trades on the ticker ADBE. The company topped our Q1 FY 2023 earnings estimates and revenue estimates on March 15th. The software powerhouse also crucially raised its annual targets on what it said was tremendous market opportunity and continued confidence in its execution. The CEO said that its Creative Cloud, Document Cloud, and Experience Cloud are continuing to be mission critical in fueling the global digital economy. So obviously they're going to always paint with like rosy lenses, but still it's good to know that the company upped its guidance, which is not easy to do as the broader S&P 500 earnings outlook continues to decline. So with this in mind, let's break down what the company does and then look at some other fundamentals. So Adobe might not be in that same rarefied air as Apple and Microsoft, but it's kind of the best of the rest tier when it comes to big tech. So the company is a champion of a vital segment of the software market with impressive subscription-based business model that's helped it post between 15 to 25% revenue growth for 7 straight years. And then it just posted 12% sales growth in 2022. So it's a really impressive run for a company of its size and age. It went public back in the mid-1980s. So that portfolio of subscription software includes Photoshop, Premiere, tons of other software that all helps people in that creative field get their job done. It's a good example to think that their products help Hollywood filmmakers, so people literally making movies that go to movie theaters, edit videos and stuff, and then also students at college or in high school. So that's how good their software is, that it ranges all the way from the average person or regular kind of artist all the way up to big budget Hollywood movies. They also have document and business portfolio business that includes PDF, e-signatures, marketing, digital workflow, stuff like that. There's also, we should note, a planned roughly $20 billion cash and stock deal to buy the privately held software company Figma. It's a relatively under-the-radar company that helps digital creators collaborate in real time via cloud software. So its offering should really integrate well into its portfolio and provide immediate benefits in a world where a lot of work gets done on individual computers. Even when people are in the same office, so it would be able to see people kind of be able to edit things at the same time, and that's the hope. Wall Street, though, was worried at the time when it announced the deal that it was overpaying. It's kind of when stocks were they were overpaying for that value for a tech company. There's also now worries that the deal might not go through and that regulators could block it. That said, Adobe's really positive that the deal will go through, and they said recently that they're going to push back against any regulatory headwinds. So we'll see what happens. That said, the deal could be a little drawn out, and it could obviously not go through, but that doesn't mean Adobe's not a tremendous company. So buying Adobe doesn't hinge only on this Figma deal closing. So that's just worth noting. And then obviously, and none of the estimates we're talking about include that Figma deal. So looking ahead, Zacks estimates are calling for a 9% revenue growth this year, all the way up to 19 billion, and then another 11% revenue growth next year, up to 21.3 billion. So besides this 9% dip, we're getting to where it's going to be a decade straight of double-digit growth. So even though we're going to have 9% growth, it's just under that double-digit threshold. The company is set to do essentially 10 straight years of double-digit sales growth, and then we're calling for 11.4 adjusted earnings growth this year, and then a 13% adjusted earnings growth in 2024. Analysts should also be raising their expectations in the coming days after the company upped its guidance recently. The stock currently holds the Zacks rank number 3 hold, and its overall earnings estimates have held up really well in recent years, despite that wider drawdown in slowing growth after that COVID boom. Overall, Wall Street's pretty high in the stock, though there are more holds at the moment than buys in terms of brokerage recommendations that Zacks has. So there's 9 strong buys, 1 buy, and 14 holds, with none coming in at sell or strong sell. So that's positive at the moment. And then in terms of price performance, the stock's up 725% in the last 10 years. This blows away the tech sector's 220%. That includes, though, tumbling off its highs, with it now roughly matching tech over the last 5 years. So it's down 50% from its late 2021 peaks as investors recalibrated all things growth. That said, the stock is up about 20% in the last 6 months versus tech's 7% pop, and it recently climbed after that release. It's now back above both its 50-day and 200-day moving averages, which is a great sign. With that said, overall, its valuation's improving as well, since it's still down so big. Falling price coupled with that continually strong earnings outlook has it trading right near its decade-long lows at 27.9 times forward earnings. This offers 30% value to its own median and 75% value to its peaks. The company also repurchased about 5 million shares last quarter, and it's also great that the company has a pretty strong line of sight into 2023, that it's able to provide that upbeat guidance. That's good to know that despite all the worries about an economic slowdown and people stop spending on software, that Adobe, in their crucial, hard to replicate software, is not going to go out of style overnight, and the people who need it are going to keep using it. So therefore, if you're a long-term investor with a really long horizon, it might be time to jump into Adobe, with it still down 50% from its peaks, with its improved value and possible decades of growth ahead. Now we're going to jump into Intuit, which trades on the ticker INTU. The software in taxes businesses are not going out of style pretty much no matter what the future holds, which is a good enough reason to consider Intuit pretty much no matter what else. So the company might be best known for that TurboTax, which people might be using at the moment as we're in tax season. But it's much more than an online tax hub. It sells software geared towards accounting, small business money management, personal finance, and others. It also spent the last several years deepening its roster to make it more attractive to a wider swath of consumers and business clients. So it bought Credit Karma in December of 2020 and then MailChimp back in November of 2021. So it now has far more offerings that it can now combine together, and it's now a much more robust business and consumer financial hub. The company currently lands the Zacks ranked number 3 hold, and it boasts over 100 million customers worldwide, and it grew its revenue between 11% and 32% in the trailing 7 years. Most recently, it destroyed our Q2 FY 2023 estimates in late February and provided slightly upbeat guidance. It also boasts a really strong history of earnings beats. So looking ahead, its revenue is projected to climb by 11% in both 2023 and 2024, so its fiscal years, to pull in nearly $16 billion in fiscal 2024, and its adjusted earnings are projected to climb by 16% and 13% respectively. So that's really solid. Its shares have more than doubled the Zacks tech sector over the last 10 years, up 500% versus 195%. Its outperformance is even more pronounced during the last 20 years. The stock's also still up about 130% in the last 5 years versus tech's 55%. Yet investors can scoop into it up about 15% below its average Zacks price target and around 40% below its own highs, as it's still, like Adobe, been crushed off those highs, which we'll see in its valuation as well. So in terms of value, it's trading at 40 times forward 12-month earnings, which is obviously not cheap. No one would consider that cheap, but you're paying for this in long-term, consistent earnings growth from a company that operates a really crucial business. This now matches its 10-year median and marks over a 50% discount to its own highs. So it's essentially trading around where it has been for the last decade, with the stock still up so much over the last decade. So great value here at the moment. Its balance sheet's also really sturdy. It pays a dividend, which is 15% higher than it was last year. It also has about $2.5 billion remaining on its current share repurchase program. And on top of all that, 16 of the 18 brokerage recommendations that Zacks has for Intuit are strong buys. So certainly worth considering Intuit now for 2023 and as just a longer term play. And the last stock we're going to look at has been in the news for a really long time, and it's had a huge comeback recently, and that is Meta Platforms, which trades in the ticker META. It used to be Facebook. Some people probably still call it Facebook. It still owns Facebook. So the company topped our Q4 earnings estimates back in early February. Since then, it's announced another round of layoffs as it tries to slim down amid overexpansion and profitability concerns. So Wall Street really had been worried that Meta and others, such as Amazon, overhired during the pandemic boom, which they clearly did, because now they're being forced to lay off tons of workers. So Zuckerberg and co. are aiming to trim their staff. The company said on March 14th that it would cut roughly another 10,000 jobs in the coming months in what its CEO is calling a year of efficiency. So this is a Wall Street Journal article I read recently, just in terms of its hiring its revenue per employee. So the hiring surge brought Meta's annual revenue per employee to 18% last year, or down 18% last year to about 1.35 million per employee, its lowest since 2014. With the announced cuts, that number could shoot all the way to a record high of 1.85 million based on Wall Street's current projections, which would be huge. So the company's doing the right thing in terms of trying to, it overhired and it's now just slimming its headcount. So it said that as of December 21st or December 31st of 2022, its headcount was at around 86,000, which was up 20% year over year. And that's up even more from 2021. That reported headcount includes the substantial majority of those approximately 11,000 employees impacted on those November layoff announcements. So they won't be on the headcount by the end of the first quarter of 2023. And then we're going to announce even more layoffs, as I just mentioned. So now let's dig into the social media giants, some of its revenue growth. So it did just post its third consecutive revenue drop in Q4. And its metaverse losses are still there. So overall annual sales declined 1% in 2022, which is a shocking turn, and which is why Wall Street was pricing in this downturn for a really long time. That's why it just got crushed and crushed and crushed. And now it's finally dropping back because it dropped 1%. And this came after it climbed 37% in 2021, 22% in 2020, 27% in 2019. You get the picture, 37% in 2018. So those days of massive, massive top line growth are going to be over for at least the foreseeable future, unless the company completely revamps or has a huge acquisition. So for full year 2022, it said that its ad impressions were up 18%, yet its average price per ad decreased by 16%. So this comes amid ad spending kind of tanks overall as the global economy slows. And then we should note that those setbacks are happening also as Apple's tracking changes continue to impact the digital advertising. So at one point, the company said that Apple's tracking changes would cost it $10 billion in lost sales in 2022 alone. So obviously digital ads aren't going anywhere, and companies are going to be able to adapt, and advertisers are still going to pay to get their ads, even if they can't be tracked as well because of Apple's tracking changes. And despite that bet on the metaverse, which the company is pouring lots of money into, and it's unclear if people are going to eventually live some or part of their lives in that new digital avatar world and actually spend money. It's unclear if that's going to come to fruition, but still in the here and now, the company operates a really stellar business. Facebook, Instagram, WhatsApp have a massive reach that advertisers simply can't ignore. And it's still growing. The company's monthly active people climbed 4% in Q4 to 3.74 billion, and its daily active users, so the people who are always on there, was up 5% last quarter to 2.96 billion. So essentially 3 billion, which is about 40% of the entire world, and a far larger chunk of people who actually even have access to the internet. We should also note that TikTok is continuing to face pressure in the US from regulators, so they could face a ban. We never know, but that would obviously help Facebook and its apps. And then in terms of looking ahead, the company is expected to bounce back in the revenue. So it's expected to do about 5% revenue growth this year to get all the way up to 122 billion, and then do about 11% revenue growth next year to 136 billion. So more just stable growth of a mature company, so like an Adobe or an Intuit or Microsoft, where they're doing kind of between 5 to 10 to maybe 15% revenue growth for an extended period of time. So, and then on the bottom line, we're calling for about 5% adjusted earnings growth and then 19% adjusted earnings growth in 2024. And we should note that its earnings outlook is soaring since that last quarter report, and as it cuts more and more expenses, just trying to focus on being more efficient and profitable as the growth slows, which is what a lot of these tech companies are doing kind of after a decade of boom and a decade in that big COVID boom. They're all kind of having to take a step back and focus on profitability, which is what's going on at Salesforce and Amazon and lots of other companies. So the positive earnings revisions have it at a Zacks rank number 1 strong buy at the moment for Meta, with just, as I said, its its current year, so its 2023 earnings estimates are up 30% from 60 days ago, and 2024 up about 29%. So just massive improvements. Plus, Meta is no longer trading like a growth company. Obviously, we'll get to that in a bit. So I got a little bit ahead of myself. But in terms of its just sheer cash position and balance sheet, it's great. It repurchased $28 billion worth of stock last year. It has $11 billion available for repurchases, and it announced recently another $40 billion increase to its share repurchase program. In terms of cash on its balance sheet, in terms of cash and equivalents, it had about $41 billion in cash, $60 billion in current assets, $186 billion in total assets versus just $27 billion in current liabilities and $60 billion in total. So great balance sheet there. And its shares have skyrocketed 120% since early November. That's when it first announced those layoffs, and it had to kind of hit rock bottom in terms of valuation. And they just reached levels that were seemingly too enticing to pass up. Yet the stock is still trading below where it was prior to the COVID sell-off back in early 2020, and around 50% below its highs at around $200 per share the last time it looked. It's now up about 650% in the last 10 years to destroy the Zacks tech sector's 220% climb. The resurgence also has it back above both its 200-day and 50-day moving averages, and we just saw, kind of like with the NASDAQ, that golden cross, which is when that short-term trend line climbs back above the long-term, which is seen as a bullish signal. So overall, though, the continued fall and its improved profitability outlook has it trading not too far above the S&P 500 at the moment, which is really stellar. And it's trading below the tech sector's 22 times. It's trading at 19.9 times forward earnings. This comes in well below its median, so 25% below its median over the last 10 years and 75% under its highs. It was trading as high as about 78 times forward earnings a decade ago. And as I said, it's now trading at 19.9 times versus the Zacks tech sector's 22 times forward earnings. The stock might be a little overheated at the moment, though, so some might want to wait for a bit of a pullback. As I said, it's been on a huge run off those November levels and to start 2023. Others, though, might not want to time things as much if you're planning to hold it for years and years to come. But there certainly seems to be a downturn due in the near term, given this stellar run it's been on. And overall, Wall Street's really high on the stock with 26 strong buy recommendations, 2 buys, 6 holds, and only 1 sell rating there at the moment. So overall, it might be worth diving back into Meta, even though it's already been on such a nice run. It's going to be a nice stock to consider along with Adobe and Intuit. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over our podcast at zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.